when the Democrats been president, it's been annualized return of 15.7%. And then, when the Republicans been president with a divided Congress, it's been 12%. So those are the best scenarios. Again, just the market views it as less uncertainty because these, again, lack of a better word, extreme policies are very unlikely to get passed.
Welcome to the Wiser Retirement Podcast, where we believe the best financial advice should be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom today is my co-host, Andrew Pratt, king of data. Hello, Andrew.
Good morning, Casey.
So, man, you got something big coming up. We talked about this in our last podcast with Robert, but you're going to be on the big stage here pretty soon.
Yeah,
in Austin, Texas. Dude. Like everybody in America is moving to Austin.
Yep, except for me.
Well, most people listening to this podcast are probably not moving to Austin. It just seems like many are. There's actually a U-Haul tracker that an investor does that tracks where U-Hauls are going across the country, and it does it by the rate, right? So there's more U-Hauls going into Austin than anywhere else. Isn't that crazy?
Yeah, it's crazy.
But you're going to be on stage with a guy in our industry who's probably like I guess they're the biggest RIA in the country, Rick Edelman. And you're going to be talking about what?
We're going to be talking about modern portfolio theory and digital assets and how to incorporate that, into multi-asset portfolios. From what I've been told, he's going to moderate. I guess things could change, but it'll be myself and a professor at the University of Texas. So I think what they're going for is kind of a back and forth dynamic of a real life practitioner and a academic. And it's not like we're going to be debating, but we submitted various questions, and I think Rick Edelman's going to moderate and just kind of, set us up.
That's cool, man. I'm excited for you because I was on that stage at one point when they were talking about ETFs. Can you imagine that? Back in 2004, 5, 6, 7, that era, we were on some pretty cool stages, situations, CNBC, that kind of stuff that we're talking about.
Do you have any of those recordings?
ETFs, so they probably do somewhere. They're probably out there deep. But yeah, that's really cool. It's one thing I love about Wiser is our ability. I kind of look at it as we're powerful, but we're like a speedboat where these really, really large firms are nice, but they're more like the huge mega yachts, right? And it's really hard to turn them. It's really hard to switch direction and pivot. Because there's honestly, these really big firms now they didn't actually grow to be that big. They acquired other companies. And so you have a bunch of stepchildren, right? Yeah. You got to get everybody on a different page.
Everyone's not ruly either.
Yeah, correct. So you have to get everybody on the same page that typically is used to marching to their own beat. Mm-hmm. And it's really hard to guide that ship. So really at a large RIA, you end up with a bunch of small companies inside a big company.
Right.
And so I'm really proud of you and your hard work in the crypto space. You have a new certification around digital assets as well. We talked about that a while back ago, but that's exciting. So thanks for raising the Wiser banner. We're not going to get clients out of that, obviously, but I think it's a great feather in a cap, and it shows that we're experts in what we're doing, especially that's probably the best digital asset conference in the world at this point, for registered investment advisors.
It is. There's some big names there for sure.
Yeah. That's cool. Well, let's get into something, probably more controversial than, Bitcoin right now. And let's talk about presidential elections and how do they influence the stock market. So this one coming up, I've been dreading this. I think it's been pretty quiet, honestly, so far. Now, I don't follow political news because there's no value in it. Zero. All it does is get you riled up, and half the stuff you read is half truths. Right. So I don't want to get riled up. I don't need to increase my heart rate. So I kind of avoid all that at this point. But there's there's this undertone amongst, I think, our client base and just people in general, that we don't want to, seeing we meaning they don't want to making changes to something in their life right now because, Biden just really ruined this country, or because Trump might get elected,
right,
or because, all these different things. Now, there are a lot of things that a president changes, right?
There are
climate policies and
tax reform.
And there's a lot of things. But we're only talking today specifically about your portfolio. So when it comes to stocks and bonds, what does it really matter?
So, I think really this can just be summarized into one main point, and you just need to stay invested no matter who's in the Oval Office, no matter how, what the makeup is of Congress. You just need to stay invested. Just looking at some data points, going back to, when JFK was in office, 1961, the S&P 500 only posted a negative return twice during a president's term. So just, take that into context. The market will...
Now, term is every 4 years.
Yes, every 4 years.
So if they were elected twice, that's 2 terms.
Right.
So it was down how many times?
So, during 2 different presidencies, I think it was Nixon and George W. Bush, where the market was negative for those periods of time. So, and you cannot forecast that. You just need to stay invested and ride the course, no matter who's in the office, no matter what the policies are. I think that's really the main goal. And we do have a graphic here that we can point to.
Yeah, if you're watching this on our YouTube channel, A Wiser Retirement, you can see this.
Yeah, and it might be a little bit hard to see, but you can see at the bottom the different presidents and their annualized, their cumulative market performance over their president's tenure. And George W. Bush, he was at negative 36%. And Richard, let's see, where's Nixon? Nixon was at negative 19, negative 20%. So
that's interesting. We don't think about President Johnson much, but that's up 46%.
Right.
Obviously the winner is going to be Newt Gingrich and Bill Clinton. Up 209%. That was 2 terms.
Right.
Bush had let's see. Yeah, well, the first Bush was up 51, second Bush down 36. That's because of the financial crisis.
Yeah.
So you could argue that it was the last year of his presidency, the last 6 months, really.
Yeah, he kind of got a bad rap.
It was very positive up to that point, and then Obama got the rebound. Bush didn't get the rebound.
Yeah, so
Obama was up 181% during the Obama administration.
Semantics there, but
Trump, even with the COVID crash, up 87% because COVID was down 30-something%.
Yeah, I think that's 67. Again, it might be a little,
67. I'm sorry, it's pretty small.
Little hard to see, but again, we don't know when recessions are going to occur. We don't know what's going to happen in the business cycle. Again, you just need to stay the course, stay invested. That's the most important thing.
I mean, another thing on this graph too is very obvious is the lost decade. And that's between 2000 and 2010, where everything was kind of flat because of, you had the financial crisis, you had 9/11, you had Enron, you had a lot of nasty stuff between 2000 and 2010. But other than that, honestly, you could argue that if you were buying in those dips during that lost decade, you made a fortune.
Yeah, definitely. 2, it's during recessions, it's easier to get out, but it's also harder to invest back into the market. And I think a lot of people, and again, it's 2 different calls. You have to make 2, if you're trying to time the market, you have to also, you have to sell at the right time and also buy back in at the right time. And that's just really hard to predict.
What people always say is, I'm going to get out at this level and then I'll buy back in when it comes back to that level.
Right.
And it's almost impossible to make that happen. You have to remember that the market opens and closes at different values. So if it closed at 10,000 and it opened the next day, it could open at 12.
Right.
I mean, we saw that during all the crises, right? But it'll this thing called the futures market, which is constantly trading, and you're not buying into that with your ETFs or any other mechanism as a normal investor. So you can't say, okay, I'm going to buy back in at this. And also, too, different asset levels move at different paces, right? So they're looking at the Dow, but on TV, but no one in our firm's really invested in the Dow. I don't know anybody invest in the Dow, honestly.
Not really.
Everyone usually just invests in the S&P 500, not the Dow. So you're looking at the Dow, trying to time you're in and out of the market, and that's not even what your investment is. Mm-hmm. So then you have to understand the S&P 500 in this metrics. But then the S&P is moving different than small caps, moving different than bonds. So, it doesn't work the way that people think that it does, as far as trying to time something.
Definitely.
So what is, tell me, you have a little research on this, the most prudent investment strategy.
So, going back to sort of the timing aspect, if you're trying to time the market around who's in the Oval Office, just say whether it's Republican or Democrat, this research looked back, going back to 1950. And if you just were invested, let's just say Democrat, if you were just invested in the market when a Democrat was president, and then just say you were in cash, you moved into cash when a Republican was president, you would have, your annualized return would have been about 5%. Now, if you did that as a Republican, your annualized return would have been lower at 3%. So
basically, if you invest only in Republican presidents, you're only up 3 annualized year over year, and you're up 5 if you invest in Democrats.
Yes. And then if you just stay invested, agnostic to whoever's in the office and the Oval Office, your market return would have been 8%. So again, another point to just ignore politics. And
but think about, okay, so let's figure out why though, because if Democrats are 5 and Republicans are 2, you think the average of that would be somewhere between 5 and 2, not higher at 8. Right. So you think that's loss of dividends possibly? Because that's about what the yield would be.
Yeah, probably loss of dividends.
So you didn't collect income because you're sitting in cash somewhere else.
Yeah. I mean, and this was closer. So Republicans was 2.8 and Democrats was 5.1. So that's closer to that 8. But yeah, I think it's just, again, probably the timing metric too.
Yeah. Oh, that's right. Because you could be sitting out for 8 years.
Yeah.
And you would miss the Clinton years, which is skewing that 5%. Yeah. Obviously.
Definitely.
Okay. So what about Congress? Does the market perform better if only one party controls Congress?
So the short answer is no. This may sound counterintuitive, but the market likes, and investors, analysts, whatever, they like a divided Congress. So meaning whether it's not just an all Republican or Democrat Congress, they like Congress that's split, because that means it's less likely for any, and I hate, lack for a better word, extreme policies to get pushed through. And that way, that rationale, it's less uncertain. There's less uncertainty because of that. So, and in this case, the divided Congress is, more certain and provides less uncertainty.
Are you curious why annuities keep coming up as a potential investment option? People are often told that annuities can effectively mitigate investment risks and help secure their financial future. However, annuities often benefit the salesperson and might not be the best choice for you as a consumer. To learn more about the various types of annuities, the negatives of owning them, and better investment alternatives, we have a free ebook on our website just for you. To download our ebook, Buyer Beware, Why Do They Keep Trying to Sell You That Annuity? Simply click the link in the episode notes or visit wiserinvestor.com/guides. Now let's get back to the episode.
I mean, that makes sense, I guess. I mean, that's exactly what you had during the Clinton years. You had Republican Congress and you had a Democratic president.
Right.
And Clinton sounds, if you look at Clinton's presidency, for the most part, at least economically speaking, he was more Republican now than some Republicans.
Yeah, exactly.
Much more tame economically back then. Okay. So what's our rate of return?
So, and when I say divided Congress too, this is this House and Senate. It's not just the entire Congress. So in these scenarios where the House and the Senate are divided, when the Democrat's been president, it's been annualized return of 15.7%. And then, when the Republican's been president with a divided Congress, it's been 12%. So those are the best scenarios. Again, just the market views it as less uncertainty because these, again, lack of a better word, extreme policies are very unlikely to get passed.
So let's bring it back to modern day. Right now, we've got Trump versus Biden with maybe a third party candidate. We're waiting to see if he gets enough votes. RFK, right?
Yes.
Waiting to see if RFK gets enough votes to be able to be on the debate stand. And that is, in order to do that, he's got to be on so many ballots across the country. His people say no problem. If he shows up, I think the other two parties would be very surprised. So let's look at Trump versus Biden. And now, obviously, Biden's term is not over,
right?
But we can take it through the end of last month, 3/31/24. What's our difference?
Yeah. So just again, analyze return during each of these presidents' term. Biden going back through March of earlier this year. Trump's analyzed return was 16%, which might be shocking to hear. And then Biden's analyzed return during these timeframes was close to 12%. So again, very solid returns for both different political parties.
Yeah, with a lot of economic drama, in the middle of all that too.
Yes, definitely.
The post-election period was both positive. Day after election, Trump up 1%, Biden up 2%. 2 months after, through inauguration, Trump was up 6.2, Biden was up 14.3. Now that's coming out of COVID. What's actually happening there?
Yeah. Yeah. And that's really just kind of, again, it's going back to the market having less uncertainty. It's now the market can, think forward and sort of just react to what the expectations are going to be, after the election result. So really what it comes down to is you've got to trust your planning process. So when we think about financial planning, we're running all of our clients through 1,000 different stock and bond market performances. So out of 1,000, and these are being predicted in the future. This is not looking at historical. So we're trying to predict where asset classes are going into the future, and we're running 1,000 different models and coming up with the median, right? That's the highest probability of success. So we want everyone to have an 80+% chance of not running out of money before age 95. Now, because the planning process is so conservative, that's fine, because we've already baked into our models a complete revisit of the financial crisis, where the market was down nearly 60% from peak to trough. So that's built into our plan. So every plan has to pass that test before it can even get to the 1,000 different variations. Right. So once we know that, then we create a safety margin inside the portfolio. This is the money that's left over when you're age 95. And that could be, it's going to be very different for each family. But inside that safety margin is your financial crisis cushion. And so when bad things happen in the marketplace, when we get concerned, we go back to those models, we reboot the engine, we run it again, and it doesn't really change much. No.
And that's the part that people have to understand. You also carry a lot of cash as a retiree, 2 years worth exactly of what your income need is. Now, if it's coming from Social Security, you don't need to count that. If it's coming from a pension, you don't need to count that. But certainly, if you're pulling it from your portfolio, you should keep 2 years worth. And then if the market is down because something economically is happening, you have 2 years worth of withdrawal before you ever have to go into any of your investments. And then the good news is, man, that cash now is paying over 5%. So you're making 5% on the cash reserve now, 5.2 exactly. And then you're also getting dividends from your investments. And then you're also going to have cash on your own for emergency reserves. So that's how you build this. To be a successful investor, you're not trying to time the markets and I just don't feel like this is good, or this is market's at a high, I need to get out. That's all very short-term, wealth killing thinking,
right?
That happens with that. So in the end, you have to have a good plan. It's no different than sports. If you tried to take a professional team and you went out there and said, all right, guys, let's go win, you know, and then it started going bad and you start substituting players and no, you have a game plan. Sometimes your game plan works. Sometimes it doesn't in sports. The good news is in finance, it's a lot easier.
Yeah.
So it's human nature. There's all kinds of books on like the psychology of money, but in fact, that's a good book itself. There's just a title. But the concept here is our fight or flight nature. It comes to work against us when we're building things. And also too, if we think about something long enough, we believe it to be true. That's another bias that we have as humans. So if we think long and hard, then we think, okay, that must be right. And I've used this example before, but I've had a family member ask me one time, about chemtrails. Right? No, there are no such thing as chemtrails. Delta Airlines is not pumping chemtrails for the government into the atmosphere, but people believe that. There's a large group of people who believe that there's chemtrails because what else is coming out of the engine? Well, that's really cold air hitting a really hot engine. And it's passing through, it's getting sped up as it goes through the blades. It comes out the backside. And guess what? You create moisture.
Right.
It's called science. That's how that happens. But people have thought about it who don't have the education and the knowledge, and they think, oh no, they're definitely putting chemtrails out there.
Everything has to be conspiracy these days.
Yes. It's just like the 9/11 conspiracy theorist people.
Yes.
It's like, I was on this website many years ago and I was like, you know what? I shouldn't be on this website because IP addresses are followed, right? But their whole thing was like nothing ever hit. It was a rocket that actually hit the Pentagon.
Yeah.
So you watch the video, that's their proof. And all you see is like a nose of a plane.
Right.
I can identify a plane. And then all of a sudden the thing's blowing up. Okay. This you're looking at it. This is the simplest example, is that when you know something about cameras, which I know a little bit about, there's frame rates. And that was a super old security camera. And, you see this, like when you rob the liquor store, and the guy's like walking, he's here, then he's all of a sudden like 5 steps ahead, 5 more steps ahead. And he's like aiming the gun. And then, it's just like that's what that camera was. It just had a really low refresh rate.
Right.
And you had a really fast moving airplane, unfortunately. That's all that was. But that was their smoking gun. And again, people with lack of education. So this is where financial planning really comes into play, because financial advisors like what we have here at Wiser, we have the education to be able to educate you. Now, unfortunately, most people just go, yeah, we trust you guys. And that's as far as they want to go. But occasionally we have the engineers and the pilots say, I want to know more. And I love those meetings because I feel like we can really explain what we do and why we do it this way. We had a pilot recently kind of take us to task over something. And I was like, oh, this is great. I think I've never been challenged this way before. So let me show you the data behind all this. And we're very easily able to show why this was the best strategy. But yeah, if you think about it long enough, you think that the president controls the stock market directly. And in some sense that they probably could. Yeah. If they were just completely negligent, there's probably ways that they would destroy a lot of wealth in the country potentially. But I don't know that we could have We don't really have dictators here, you know?
No, I mean, and every, whether it's more lenient tax policy with the Republican side or more stimulus, pro-economic inflation act on the Democratic side. I mean, I feel like each president has kind of, different policies that do sort of help and support the markets in different ways. And, maybe some counterbalance that, or, if I guess a concern is Trump kind of getting in Jerome Powell's ear and sort of making the Fed, more kind of political.
That may be uneasy back then. Like, why are you challenging the Fed directly? People don't do this.
But the Fed's been pretty, and Jerome Powell's been there for Trump and Biden now. So they like to remain, neutral, and that's their goal, is just to combat inflation.
Right.
But yeah, I feel like no matter who's in office, there are, different policies that can hurt and help the market.
But we have a free market. Capitalism is, in the U.S. is a free market. And so as long as capitalism can do what it needs to do,
right.
If you put a soda tax and you taxed soda to the point where no one was buying it and Coke was suffering, then Coke's going to innovate a different product to make money with. I mean, that's the beautiful thing about the free market system, is that people are going to find ways to make money.
Yeah.
Even if they have to go sell soda everywhere else but the U.S., they still make a ton of money because there's more people who don't live here than the people that live here, right? So there's always ways to make a dollar. And then we have really smart people in this country that figure that out.
Yeah. And for instance, too, another point would be like a lot of these big companies like Coke, they're multinational companies. They have a chunk of their revenue coming from overseas. So, I mean, if there's some restrictive policies that are passed here in the United States, they could maybe focus more on their international markets. I think the SP 500, it's about 40% of its revenue is coming from international markets.
Yeah. Yeah. I think I'd say higher than that, actually, but
it might be a little bit higher.
But yeah. So the bottom line is you can create a lot of anxiety in your own head over all this. And I would encourage all of our listeners, as we go through this political season, to understand that, as a famous quote here is, the markets in the short term are a voting machine. They're going to move with emotion. But in the long term, it's a weighing machine, right? William Bernstein said that. So in the long term, it's a weighing machine. So only the companies that make money survive. That's where it really comes down to. And that's the beautiful thing about investing. When you invest in long-term healthy asset classes like the S&P 500, it's you've eliminated that specific company risk. And now you can focus on, these charts that we have up on our, up in this podcast post. All these charts are moving up very aggressively from the left to the right with some nastiness in the middle. There's no doubt about that. We went through some stuff over the last 20, 30 years in this country, but the markets all bounce back. You know why? Because all these companies made money. That's what it comes down to. Every one of these companies making money. If they're not making money, they go out of business.
Yeah. And it's an index, and the index is efficient because, it's the 500 largest companies. So
in order to get in there, they have to have made money.
Right. And then they'll kick out the ones that aren't making money.
Right. It's a self-healing index.
Right.
It's people say, oh, the S&P, don't invest in that because it's only the top 7 companies that are carrying it. Yeah. It's based on market cap. Those are the winning companies.
Right.
We talked about this before. I don't know if it's on the podcast or maybe it's one of our meetings, but those top 7 companies have more cash on hand. What did we determined Apple had in our conversation? Wasn't it?
I'm trying to remember.
Was it 400? Was it 400? It was in the billions, wasn't it?
Yeah. I mean, they have.
Is it 40 billion? It was a lot of money. 140 billion, I think is what it was. It was a lot of cash. You think about that. You have billions of dollars in disposable cash in your company. You can create whole new verticals.
73 billion.
73 billion.
Yeah.
Apple right now is sitting on $73 billion in cash. If they wanted to create a car company, they literally have the money to do that. Now they've axed that concept.
Yes.
But what else are they developing that they would continue to be the largest market share in the country?
Yeah, I mean, I know that they've received some criticism for not jumping in on the artificial intelligence space, but I think it was like maybe a couple of weeks ago, they did announce that they're looking into making their own chips for artificial intelligence products down the road. So I think their stock has been performing well lately, but they're, say what you want about Apple, they're always very cautious and prudent with how they use their cash and make investments. So they're not going to just jump into an area just because that's the hot theme right now.
Right. But the point is that they have the ability to do it.
Yeah. They're able to be nimble and navigate.
Right. Even in the other 6 companies that are top in the S&P right now, I wouldn't say that any of them are fly by night or have the capable of going out of business tomorrow.
Right.
No. They all have a tremendous amount of cash. So the bottom line here is don't create your own anxiety about all this. In the end, we all want our sports teams to win. We all want our political candidates that we choose to win. But in the end, what I want to win is the free market system and the ability to create companies. And right now, this is the only place in the world that you can go and create companies and live out this American dream.
Exactly.
So, all right. Thank you. Good luck at your conference next week. And
I guess it's 2 weeks.
2 weeks from now.
2 weeks.
All right. Mm-hmm. And we will, we're sending Robert with you. So he said he would do a live feed.
He'll keep me in line.
Yeah. He'll keep you in line. We'll see if we can get a live feed. I told him we would either, get the video back. We'll either, we'll embarrass you or we'll celebrate you.
Yep.
All right. Thanks, Andrew.